What is up, everybody? My name is Cole. I'm a part-time real estate investor, full-time legacy airline pilot, and a part-time military instructor pilot. Today, I'm going to be breaking down a deal that I think is not great, but it's being positioned in a way that could be confusing to a new investor. So I want to illustrate, using a larger deal, what exactly can be hidden in the weeds if you don't know what you're looking for. So I'm going to jump to my computer. I'm going to show it to you on the screen share. I'm going to show you step-by-step what I'm looking at here to figure out whether or not this deal is a buy or a bust. It's got some interesting documentation along with it that might try to convince you, if you're a new buyer, that this is the deal for you, when in reality, I don't know if that's the case. I'm going to go ahead and walk you through it, show you what I think about it and what I'd be leery of, and try to make you a little bit more educated when you're going to go buy your first, maybe your second, or your 100th rental property. Appreciate you guys watching, and let's go over to the screen share. See ya. What is up, everybody? Here we are in the screen share. I literally just went and typed in Milwaukee apartment buildings for sale, and I'm on LoopNet, which is totally free. You can pay for it. As you can see, I'm not even logged in on this bad boy, so I didn't pay for anything. I use MLS usually because I'm a real estate agent and I have access to it, but I wanted to show you guys how I can do this without even having access to the MLS. So I literally just went to this property, 319 West Bolivar. I just happened to stumble on it, and I was like, interesting. 14 units for $1.575 million. This is not an uncommon price. You can see a lot of these buildings are in that same neighborhood of price. I just did one on this building as well. So it's not like they're asking some astronomical number, but I want to show you that this doesn't actually make money. It doesn't cash flow. It loses a ton of money, but it's being sold as if it makes money. And I'm going to show you how that all works. 319 West Bolivar. We got it over here. Not a bad looking building. It's super clean brick building. I like brick buildings in general. Nothing too crazy though. It's a landlord special, as you can see. Pretty basic, clean, dry basement, decent looking appliances and whatnot here. Nothing too crazy. I condensed this down. You don't necessarily have to read all this. It's talking about how the rents are below average. Everybody says the rents are below average because that's just what people do. They try to increase the value artificially by saying, hey, these rents should be raised. Well, if they should be raised, why didn't the previous owner do that? That's always my question, but no one tends to have a great answer for that. So then if you look at this, we've got all the information about the property and its expenses, right? So I transposed the majority of these over here. You'll notice here there's a missing piece for management. Maybe they manage it. They said that this caretaker for $600 a year is managing the whole building. I don't know. It could be accurate. Maybe it's not, but I put in what I pay for management fees at 8% of this number. So I rounded up to $15,000. But if you look down the rest of this line, I was pretty generous with them. I gave them a lot of benefits of the doubt. I didn't beat them over the head as far as this stuff goes. I stuck pretty close to this list. I made some adjustments. Insurance, I went up a little bit because I know what it's been costing to try to get insurance, but only $800, right? So if you see here, I came up with $84,000 worth of expenses against their 63, and the main difference there would be the management fees here. I think we were doing okay as far as giving them a chance to make this thing profitable. Here's the rent rolls. You can see, generally speaking, these rents are pretty close, but everybody says they should be higher. So I literally told them, okay, I'll give you just over $1,000 for your 2 bedrooms, even though they only have maybe 2 of them that are actually at that price range. And could they get the rest of them all up that way? Sure. But it doesn't happen overnight. A lot of times you're not going to be able to adjust these. Maybe these are on year leases. We have no idea what the lease situation is here. So if these people are on year leases, you're hosed. You're not going to be able to raise those even if you wanted to. And I don't know that you would want to. Those people could move out, and then you have additional costs of resetting that unit for somebody else. So there's a lot of trickle down effects if you just decide to artificially raise them to what the pro forma says they should be. And as you can see, I give it a great name here. But anyways, I gave them the benefit of the doubt. I literally took them from 12.7 to 15.1, which is a significant change. If you math that out, that's a massive change. This is assuming that you got up to that immediately, which you're not going to do. So you can see as you look down a little bit further, I don't want to get too far ahead of myself, but if you look down further, even with giving them that extra $3,000 a month almost, it's not quite going to make this stuff work. But I did notice this document, which I thought was interesting. And here it's being sold $1.575 on the price, $315,000 down with a first mortgage of $1.26 million. And they're saying 6.25% interest. I just don't see that being realistic. I put 7% into both of my calculators. I got one up here too. I just don't see 6.25 being realistic. And when they made this, it may have been realistic, but I just don't see that anymore. 5-year note, that's not crazy. This amort over 30 years means it's being amortized. The payment's being split up amongst 30 years, and it's locked for 5 years. That's not crazy. Most investment properties find themselves in that situation. And so the net annual income they're saying is $85,000, and I actually came up with $88,000. So there we're really not that far off. You divide this out by 12 months, you see what they got, and long story short, this loses money. You can see you're losing about $600 a month as far as your payment goes. You're feeding the building from day one, and you put $315,000 down. Now I'm gonna let you just sit there for a second and think, what if I put $315,000 down in the S&P, or if I bought Hims, that's a hot one today, or Oscar, or some other stock? What could I do with that $315,000 versus losing $600 a month? That's one thing. But then we continue down. He says principal reduction on the loan monthly is approximately $2,840 times 12 months. So he's saying that you're going to pay down $2,840 worth of principal reduction every month on this loan size. And I can tell you right now, that is not entirely accurate. That's not even close to accurate with what I've seen. Now, I'm not saying, I don't know how he came up with this, but I've got loans that are in these ranges, and I am not even close to that. If you actually go over here, this is just off NerdWallet, which is just a free website. If you look at what they've got, you can see, I already scrolled down to see where it would start being close to that. When you start this loan, you're only paying about $1,000 a month in principal. And it's not until, let me keep going, it's not until about 2040, the beginning of 2040, before you're even getting close to that kind of principal reduction. And by that point, you're only paid down maybe $300,000 worth of principal. What is that, 15 years from now? That's not even close to accurate in my estimation. That is not even close. They're calling for $34,000 of principal reduction, and they're using the principal reduction as a way to generate a return, right? So they're saying you're going to lose $7,000 in cash flow a year, but you're paying down the loan value. So if you take what you paid down on the loan value, which we don't believe to be accurate, and you subtract out the freaking loss, you're actually making $26,000 a year. And there's nothing more American than this right here to me. I just think, okay, yes, if this is a business, you have to look at this as a business. If someone was selling you this business and they told you, well, actually, you're going to lose, if you buy this business, I need you to give me $315,000, but you're actually going to lose $7,000 a year. But the thing is, you got a big giant loan and you're paying down that loan. So you're actually getting $26,000 a year in return. And I understand that there is an aspect of principal reduction, but it's not nearly this pronounced, and it doesn't really matter. To me, I don't really care. If I'm losing $500, $600 a month and I had to put $315,000 down, then this to me is, I'm already done. I'm already out. But there's more to read, right? They're taking the $26,000 and dividing it by your down payment, right? So they took your principal reduction, subtracted out your losses from cash flow, and then divide that out by the $315,000 that you have to put down. They say it's an 8.5% return. And they're saying the average appreciation in the last 10 years for this property is going up $45,000 a year. And they're basically looking at, okay, 10 years from now, if you own this property for another 10 years, you're going to make another $45,000 a year. So they're taking 45 and they're adding 26. And that's how they're coming up with $72,000. And they're dividing that by your down payments to say you're getting a 23% return. I understand that not everybody really deeply understands the math on these properties and what the implications are. But the plan here, if you bought this property, the way that they want you to play the game is your only hope is that you're going to reduce principal and that the property is going to continue to go up every single year by $45,000 a year. And it could. I'm not saying that it can't by any means, but that's your only plan. There's no cash flow plan. There's no plan to get this cash flow up. Granted, they say the rents are low on average, blah, 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 blah. But this whole page to me was just, that's the reason I'm making this video, is because this is insane. If you were an uneducated buyer, you could look at this and convince yourself that this is actually a good deal. And it's not a good deal at all. It's a terrible deal. And I'm not saying that somebody won't pay this money for it. That's not what I'm saying. I'm just saying if you're a new investor or you're an early investor, this is not where you need to be putting your money. This is absolutely not the place to be. I transposed all their information, right? I gave them the benefit of the doubt. I said, you know what? They are going to raise those rents. They're going to get those rents way up. $15,160 times 12 with a 5% vacancy for people moving out. It gives us this number. Subtract out all these expenses. I'm not going to go into them in detail because you guys can read them and pause the video if you like. Total expenses of $84,000. So 50% almost of your gross is in expenses. So that leaves you with $88,805 a year. My debt service, this is how I calculated it out, $8,382 times 12. So you need $100,000 a year to pay, just to make your payments, right? Just to pay for everything. That's not making a profit at all. So you're showing, I don't know, just about $12,000 a year in losses. So you're going to be down $12,000 a year if you buy this building, and you also have the $315,000 down. Now, could you pay it down? Of course, and eventually it'd be worth more money, and the game could continue going up forever. Now, let's say the game doesn't go up forever. Let's say that this whole plan is all you've got. You're going to take a $12,000 loss every single year, and actually you buy this for $1.5 million, and next year there's a 10% haircut. You're down $150,000 on the value of the property because that's the only thing that you're betting on. You're not betting on cash flow. There's no chance. This is with everything running perfectly, and it's still losing 12 grand a year, and it's not running perfectly. They still say that there's all this room to be growing. So if you extrapolate that and you say that you take a 10% haircut in the next 5 years, now you're down on your you're down on your down payment, and you have no cash flow to lean back on. You can't sell this as a profitable business. You can't. There's nothing you can do. And the next thing I would be thinking about is, okay, let's say I do buy it. You know what? I've got 300 grand laying around, and I really need it. It's burning a hole in my wallet. I tell you that. I want to buy this building. If you do that, and the price does stay the same, guess what else can change? Interest rates. Now everyone thinks there's no way that we could ever get back to double-digit interest rates, but we've been sitting in the 6 and 7% range for a long time now. I don't think that there's an unreasonable scenario where we see a 10% interest rate. And if you sit on this property for your 5-year term on your commercial loan, and the note comes due, and you have to refinance it, and now you have to take it to 10%, what happens to this number? I can promise you it's not going to be good. Let's just take a look real quick. Let's extrapolate this. Let's say we're going to go to 10% when we refinance this building. And this is assuming that we bought it like this. With nothing else changing, I guess we can leave it alone. If with nothing else changing, your monthly total will be in the $10,000 range, right? Now, I know I didn't do this math exactly right. I know that somebody's going to say, you really should be starting, you should have set this start date differently and whatever. It's still going to be a lot more. And in this case, it's going to be about $2,000 more. So now you extrapolate that out. Now you're losing $20,000 plus a year, and you have no exit because now your initial down payment is eaten up, or at least it's damaged in some way, and you can't sell it, you can't cash flow on it, you have no hope. The only hope you have is that these just skyrocket and that you get an emergency parachute because the rents go to the moon. So that is a quick breakdown as how a deal like this can be sold to you as if it's the holy grail and you're going to make 26% on your money, and in reality you're just giving somebody a bunch of money for something that will never cash flow unless something extraordinary happens in the market. When I saw this, I said to myself, there is no way that is being sold that way, but it is. And no fault to them. They're trying to make a sale. They're trying to get rid of the building. If you're starting your investing career and you're trying to figure out where to buy and what to buy and how to buy, I can't tell you necessarily what to buy, but I can show you what not to buy. And in this case, I would definitely pass on this. $315,000 could go a hell of a lot further in a market like Milwaukee and other markets as well. If you're looking at getting into your first purchase, I implore you to take a chance to sit down and try to look at some of these deals and critically think about them. Get an Excel spreadsheet like this or something else and try to plug and play these numbers to see what it actually looks like, because if you're just getting your story from the listing agent, you're only getting one side of the story and you're probably missing a lot of nuance in that. I'll continue to make videos like this to try to shed some light on deals that are out there. I'm just picking ones at random. If you have something specific or you want me to look at a deal, drop it in the comments. Let me know. I'll take a look at your deals, throw them up here, see if they make money, see if they're worth buying. I appreciate you guys. If you spend any time watching this video, it means the world to me, and I'll talk to you guys soon. See you.